We're talking about bond valuation today and just the basics. And so I want us to be able to differentiate. We've talked about notes payable. We haven't talked about bonds yet. So the goal of this is really to know what the difference between those are and other long-term liabilities like leases. Understand the terminology we use when valuing bonds, which includes like this par, premium, and discounting of bonds, and what we also call the stated rate and the market rate, and then how to calculate the present value of the bond using Excel. You might have to use a calculator in future classes, but in the real world, we use Excel or we use Google Sheets. And that's why I'm going to teach Excel or Google Sheets in this class. And you're allowed to use Google Sheets and Excel for your homework and your quizzes and your test. So what are bonds? There's a lot of confusion here. Most people think of bonds as like treasury bonds. You get it from the government, right? Like you hear about the 10-year treasury rate or the 15-year treasury rate. Those are a type of bonds. But what a bond is fundamentally, it's a contract similar, it's a debt contract. So it's a legal contract between a holder, a person or entity purchasing a bond, and an issuer, a company, or it could be a government or any kind of agency seeking financing. It normally has very similar structurings to a mortgage. Except they do semi-annual payments instead of monthly payments. And so to take a step back, right, we know that businesses, the accounting equation really summarizes what businesses can do, right? How they run their business from a financial perspective. We have assets, what the business has equals liabilities and equity. What does that mean? We can fund the business with either borrowing money from sources or by ownership contribution or our operations, right? Which is equity. We're talking about liabilities. So we're borrowing money. Companies can borrow money. We talked about accounts payable and all these short-term ways that we can borrow money. Now we're going to talk about long-term ways. One of the main ones, the two main ones are bonds and notes payable. Bonds are the most common way large public companies will issue debt. And what they're doing is they're going to go to the marketplace and instead of issuing stock, they're going to say, we want to borrow $100 million. We're willing to pay 8% interest. And then investors, either banks or individuals, can go and then buy that debt, right? What in essence we are doing is lending our money in exchange for a return, the interest rate. That's what we're doing in bonds, right? So it's a public offering. It has to be on the stock exchange or the bond exchange. It's a public offering of debt from a company. It has to be traded on the open bond market, right? Like it has to be open to investors. Any one of us should be able to go and trade and buy. Like you could go buy a Google bond or you could go buy a Microsoft bond. And it's a written promise to pay an amount with interest, right? So you might lend the company $1,000, you pay $1,000 for your bond, you expect to get your 8% interest. Today, it's more like 2 or 3% because of low interest rates. Typically, companies do this to fund large projects. So they might decide they need to buy a new office, or maybe they want to purchase another company. They might issue a large amount of debt to do that funding. And most commonly, they offer semi-annual interest payments on those bonds. So that's the main difference between bonds and equity. And there's a lot of complexities between should we sell stock or should we sell bonds? And how should we raise our capital? And you'll learn that in advanced financial courses and if you ever take your MBA. But for this class, I'm just talking about what the bond is. So this is a class. What is a bond here? Which of the following is a bond? A company can borrow 10 million. I can't read the questions today because my throat's dry, but I'll let you all just read through it and then answer.
It's C, right?
Yeah. Why is it C?
Because they're like selling the debt and they're going to pay interest to the people who buy it.
We're issuing the debt in the open market. And that's the key here, right? Yeah, we are selling the debt. Good takeaway. But it's in the open market and we're paying interest, and it's semi-annual, right? It has all the qualifications we talked about. Why is it an A? Company borrows 10 million from a bank, right? If it's from a bank, we're talking about notes payable, right? It's no longer a bond. The bond is on the open market. What does the open market mean? It means that once someone buys it, they can sell it to other investors. While like the bank, you can't sell, it's very difficult to sell a bank note. But if I buy a bond, I could sell it to Majaba the next day, right? If he wants to buy it. If they provide 10 million to a real estate developer, that's just a sale of land or purchase of land. Or if they lend 10 million to a private investor, that's actually a receivable. Like we're giving money away and expecting to collect interest. So this is the key takeaways here from all those other slides that on the other the chapters slides. I really want you to make sure you need to memorize these definitions. Who's the issuer? The issuer is the company selling the bond. The holder is a company or individual buying the bond. Make sure you understand those differences and who it is in the relationship, right? Because that changes if it's a receivable or an asset or a liability. If you're who's purchasing the bond or who holds the bond or is issuing it. Maturity date, that's the date you'll get your principal back. So if I was going to give you $10 million today, you know, I'd rather you give me $10 million. So if I was going to get $10 million today, if I'm the company, and I had a maturity date of 10 years, I'd have to give that 10 million back to you in 10 years, plus pay you semi-annual interest payments. That's different than a mortgage, right? Mortgage, you're paying a little bit of the principal every month. But bonds, generally, you're paying the interest semi-annually, and then you pay the full principal at the end of the bond's life. The face value of the bond, that's the principal the bond can be redeemed for on the maturity date. So on the bond, if the bond says it's worth $10,000, that's the face value of the bond. What's interesting is the face value of the bond can be different than the actual value of the bond. Now, so this is where it gets complex and interesting and more financial. And the reason being is because interest rates change, right? We'll go into this in detail in the next ones. So just know, I need you to know right now, the face value of the bond, what's written on the bond, can be different than the value in the marketplace. Does that make sense? Just know that. Just know that's a fact, and then we're going to explain why in the next few slides. But I could buy a bond that has a face value of $10,000 for $5,000 or for $15,000, and we'll go into why that is. The stated rate, this is also known as a coupon rate, nominal rate, and contract rate. These are all synonymous. This is the stated annual interest. So on the bond, it'll say your base value of the bond and a stated rate. I'll show you a picture of a bond. We don't really hold bonds anymore, but I'll show you what it looks like. And I'll say $10,000 at 5% interest. The market rate might be different than that, which could drive the valuations, change the valuations. No, the stated rate can, coupon rate, nominal rate, and contract rate are all the same. They all mean the same thing. This is what's written on the bond. So both the face and the stated are on the face of the bond, like on it. It's going to get confusing, so I really want that to be clear. Like that's what's on the like the bond's a contract, so it's what's on the contract. The market rate is changing every day. You can listen to the news. The market, you'll hear, oh, 10-year interest rates went up 2%, went down 1%, went down a point. Not normally percentages, but points. That's the market rate. That's variable. That changes. So this is what a bond looks like. It covers the terms. You need to know all these, right? Memorize this. This is what a bond looks like. You get the company's name, right? We have the face value of the bond, the $10,000 principal. You get a stated interest rate, the stated maturity date, which is the redemption date, and the stated issuance date. You get all that information. This is a legal contract. If you hold this and it's been signed over to you, you have a right to this money. Does that make sense? You buy it, it's an asset. You have a right to this money in the future. If you issue it, it's a liability. It's a bond liability from the company. So